Hello, everyone, and welcome to our monthly webinar. My name is Justin Cooper. I'm a hard money lender, full-time real estate investor, coach, and consultant. Each month, we bring in some of our friends in the industry to share their expertise. This may be through a presentation, like when we talk about self-directed IRAs or title insurance, or we may simply interview our expert friends and dive deep into how they got started, where their investing has taken them, and what they see coming both for themselves and for the industry. Now, this webinar is brought to you by Pine Financial Group. Pine Financial is Colorado and Minnesota's premier hard money lender. Pine focuses on the needs of Colorado and Minnesota real estate investors, and we're investors ourselves, so we know what it takes to get deals closed. Everyone at Pine Financial Group is dedicated to the success of its clients. We only experience success when our clients are succeeding, so we have a habit of telling you when a deal should or should not be done. And isn't that what you want from a professional in the industry, especially someone that you trust as an advisor? You will benefit from our honesty and integrity when you choose to work with us. Now, tonight's webinar on house hacking and the nomad strategy will help show folks alternative ways to get into investing and build their rental portfolio. I'm excited to introduce Chris Lopez, as he's one of the folks who's helped me buy several of my rentals. Chris is an investor-friendly realtor at Your Castle Real Estate. He helps investors buy rentals, house hacks for retirement income. And Chris is currently house hacking himself to reduce his monthly expenses. Now, Chris, go ahead and tell us just a little bit more about yourself before we dive into tonight's topic.
Of course. First off, I got to say, Justin, I'm impressed with your radio voice, man. I like it.
Well, I definitely have been told I have a face for radio, so I don't know if that's the same or not.
Yes, I mean, you did a great job interviewing me there, so thanks a lot. Just add some more color on there. You know, I'm in my upper 30s now. Right around when I was 20 years old, I read Rich Dad Poor Dad, which I know probably about 90% of our listeners or viewers tonight have read that as well. That planted the real estate bug for me, and then didn't really start getting into real estate until my early 30s is when I was finally in a position to get into real estate. And I really like the part of real estate on just really building that longer term income. I've done a fix and flip, not for me, but that as I was doing different investing strategies, researching, trying stuff, talking to people, I kind of found out my niche. And that was really focusing on buying rentals and doing that longer term financial strategy. There's lots of great information on the internet about, finding a great deal, but not nearly as much as, great, we buy a property today or you buy a house hack today, another one a year or two, another one a year or two. How do we make this chess game work out so in 20 years, you're doing an early retirement? So what I focus on is helping people find the properties, and we also then do a lot of the education and that long-term financial planning for our clients. So we'll talk about today's webinar is we're going to go through house hacking for the Denver market. Now, of course, I'm going to be sharing some very specific numbers here on the Denver market, a lot of the frequently asked questions. So obviously it might change a little bit different if you're not in Denver, but I know the up and down the front range were pretty similar in terms of like ratios and common things. But I'm also covering a lot of common, I'll say, misconceptions and some frequently asked questions I get from my clients, which I think will apply to everyone around the country, Justin.
Perfect. Yeah, absolutely, Chris, because we do have a national audience here joining us. And if I hit the record button in the right way, then we're going to be posting this on our YouTube channel as well. So absolutely, we'll have folks from around the country. So that's a great point that obviously the deals and the numbers will be specific to Denver and today's market basically, but the principles apply across all markets. So that's a great point, and I appreciate you bringing that up.
All right. Can I jump in?
I'd love it if you did.
All right. So probably should actually show my title slide there while I was talking, but that's how I look now. I a lot of times teach this class with Joe Massey. He's a lender and investor here in Denver, but he won't be joining us tonight. So really before we jump into the actual specifics of house hacking, let's start with the goalpost. Where are people working towards? Because really, we're buying real estate. I know I am. I know you are too, Justin. We mastermind a lot together. We're all buying it for some type of early retirement income cash flow. So let's start with that end goal in mind and then work backwards and say, hey, how can a house hack that you buy today with very little money down, that doesn't cash flow a whole lot today, but how in 20 years can that set you up for an early retirement time frame? So Justin, I know you talk to lots of people. I talk to lots of people. What's the most common number people tell you when they say, oh, I want X amount of cash flow per month for my real estate?
Oh, well, I mean, first off, as much as possible, but probably
give me a number.
Let's say 500 a month.
500 a month for retirement, for long-term goal.
Oh, how much do I need to retire?
Yeah, for that, for like your clients and people you talk to.
Oh, I need 3 million at least.
In monthly cash flow?
Oh my gosh, Chris. Should we just start all over again? I'm not even like listening to you, I guess. Let's
I think you need to
say
go drink some more coffee or Red Bull.
I definitely need more coffee. It doesn't matter what time of day. I need more coffee. Um,
So
10,000 a month. How's that?
that's actually exactly what it is.
I did it.
Yeah. And I mean, I am not kidding. I mean, 9 out of 10 people, it's $10,000 a month. The other one, it's like 5 or 15,000 most common. So $10,000 a month, I'm going to run a lot of examples through here because that's what a lot of the people need. And we're talking $10,000 a month after expenses, and that's what you have sitting in your bank account on a monthly basis. So
Well,
I know a common
Chris,
rule.
right there, that's an interesting point, man, because when I'm hearing people saying it, they just say 10,000 a month, and they don't necessarily say is that before expenses, after expenses, pre-tax, post-tax. They just say 10 grand. So already, I think you're clarifying some things that are going to be really important for people sitting and listening. Already that's something to be paying attention to. So I love it. So keep going. I didn't mean to interrupt you there, but
No, you're
really like
you're
that
good,
point.
dude. I love the dialogue. So, I was about to say, you have to clarify what you want. That's important. The devil's in the details. And a common rule of thumb, I hear this on Bigger Pockets and lots of other investing websites and podcasts, is that 50% rule. They say whatever your rent is for that unit, 50% of it is going to go towards towards all your non-mortgage expenses. That's your operating expenses, your property management, insurance, taxes, CapEx, repairs and maintenance, landscaping, all of that stuff. So it's definitely true in some markets, but that is a blanket rule that does not work well in the market. Doesn't work well for us here in Denver, Justin. Some markets are lower, some markets are higher. So don't use this 50% rule if you're in Denver. If you're in a local market, really find out what the true operating expenses are. Because if, we have higher rents here in Denver, replacing a water heater in Denver isn't that much more than replacing a water heater in Des Moines, Iowa, but our rents are 2 to 3 times higher than there. So it's a different percentage.
Absolutely. Yeah. That's conversations. And anytime, and I'm sure you have these conversations all the time as well. Folks who want to invest outside of Denver's too expensive. I can't make the numbers work. So they go to one of these other, better cash flow markets, or they're looking in those. And that's something right there, right? The entry price, the purchase price is much lower, but the rents are much lower too. And thus those same normal expenses, repairs and maintenance, CapEx type things are basically the same thing, right? Across the country, the water heater, the roof, same dollars across the country, but you're bringing in less money. So right there, again, sorry to interrupt, but I love where you're going with all this stuff. Keep going.
And so what we found here in Denver is actually, on that note, a lot of times I have a lot of clients who invest out of state. I'm like, hey, if it makes sense and you got a competitive advantage, go for it. But I'm also like, hey, are you in a position to house hack? If you are, you should look at that because, house hacking here in Denver, a lot of times they're less money out of pocket by buying a house in Denver than they are doing an out-of-state investment, and they're saving money on rent. So it's very nuanced here. So here in Denver, we use the 33% rule. So approximately, we see a lot of times rental properties in Denver, they run between like every dollar of rent you bring in, about 25 to 35 cents per dollar goes towards operating expenses. So as a quick rule of thumb, we use 33% so we can do mental math and be slightly conservative. So if that means if you want $10,000 a month after expenses, here's the simplest way to look at it. Well, that means we need $15,000 in gross rents. Because Justin, what's 33% of 15,000?
5,000.
Yes. And then, so that's your operating expenses. And, that 15,000 minus 5,000 gives you $10,000 in income if it's paid off properties. Or if you guys are familiar with some of the more advanced metrics, this is also the same as your net operating income, or NOI. It's the same number because your NOI is the same whether you have a mortgage payment or not. So for really simplistic modeling, we just look at, hey, let's find that NOI number you're looking towards and work backwards there. And what this does is, hey, if we need $15,000 a month in rent, Justin, you're closing on a condo tomorrow. What does that rent for a month?
Well, we've got it marketed at like $1,995, I think, right now.
Okay, so I'm going to do 2,000 to keep it simple. So 15,000 divided by 2,000. means you need 7.5 condos.
Yep.
So it's a very easy way to kind of, oh, great. It kind of gives you that end goal of what you need towards without having to do fancy calculations, and says, oh, 7 properties is actually very doable over a 10, 15-year time horizon, if not sooner. You don't have to have 50 units. You don't have to have 20 trailer parks. Hey, 7 condos or 5 homes in Denver will get you this income. So I said the exact number, it depends, as Justin and I just talked about. So a really common goal we see here in Denver is between 8 to 10. Justin was at 7.5. I rounded that up to 8. So right in that line right there. So, I want to compare this, and Justin, this is great since you're a hard money guy. You know the BRRRR strategy, right?
I'm very familiar.
You've heard that once or twice, and then 1 or 2 of those before?
We were teaching the BRRRR strategy before it had the fancy name BRRRR strategy.
Well, you should have trademarked it.
Well, we called it buying rentals with little to no money down. It doesn't roll off the tongue quite as easily as BRRRR. So that's why we didn't trademark it.
And this is something I think Bigger Pockets coined this term, and great marketing job on the name there for them. But it stands for buy, rehab, and generally speaking, when you buy the property, I'm talking to you, Justin, to get my hard money loan to buy the property, rehab it, rent it out, and then I talk to my conventional lender. I get a new longer term loan. He pays you off, and hopefully I'm getting some money back or have very minimal out of pocket if I got a really good loan from you. And then repeat. So BRRRR. So this is by far, this is the sexiest investing strategy, and lots of people want to do it. The problem is in our current market cycle here in Denver, and I think lots of parts of the country, we're in a very hard market cycle because we're in such an extreme seller's market. This is very good when you're in a buyer's market. But when you're a seller's market where properties are getting bid up, even if it's an ugly old property, they're still trading towards, at a premium. So it's really hard to find things with a good margin here. So I want to kind of compare the BRRRR strategy with going through and doing the House Hacking and Nomad strategy, because a lot of people get so hyper-focused on the BRRRR strategy. They want that, they're a grand slam property in Denver right now. Justin, your condo, that's actually one of the better condos we've seen this year. That's a double, that's a really good double. We usually shoot, hey, get a base hit. It still plays in the long run. House hacking, you're not getting rich on the cash flow from day one. So with the Nomad strategy, which one of our buddies, James Orr, coined this term, you buy it as an owner occupant, just like you would as a house hack. You live there for 1 year, then you buy a new home, convert the previous home to a rental, and then you repeat the process until you reach your financial goal. So Justin, use your example. If you're nomading these condos, you move around 7.5 times. And then you'd say, cool, I'm done. I don't have to do anything else as long as you don't be a financial idiot and go bankrupt and spend all your money. Let those properties pay off. You'll hit your retirement income going real estate is a really simplistic way to look at it. So house hacking versus nomad. Nomad, we like to stress that term is where you are out there and definitely going out there and buying, multiple places every year or two. Where a lot of times house hacking is focused on getting such a great deal, buying a great duplex or buying a great fourplex, which is great, but it gets very singular property focused. And Justin, if you go out there and buy 8 condos over 7 years, buy 1 duplex or 1 fourplex and live in it for the next 8 years, in 20 years, who's probably wealthier? You are.
Yeah, because I have more properties.
Yeah. And, condos are easier to find than multis right now in Denver. So like to distinguish between the two, I'm just going to kind of use house hacking for the rest of the presentation to just lump them both together. But when I talk about house hacking, buy the house, live in it, but make sure you're buying a future rental property and you want to move out there within a year or two, whenever it works for you, and saving up for your next down payment. So let's talk about investing.
Can we go back to that slide? So I just want to make sure that we're being clear on what these two different strategies are. So the Nomad, I actually really love the name of that, because you're a nomad, right? Every year you're moving, right? And so on day one, year one, you're buying a house, you're moving into that house, and you're living there for at least a year, because generally, right, they're buying with owner occupied terms. Is that what the typical plan is?
Yep. Usually like a 5% down conventional.
Yep. And so you have to live there for at least a year, right? Because that's what you're getting a loan for. That's what you're telling everybody you're going to do. So you have to do that. And then maybe at the end of that 1 year, now you can buy the next property, move, and keep going that. But it's your house. You live in it by yourself or, with your family, something like that. And then you move out and turn it into a rental. Whereas the house hacking, you're buying I'm assuming typically, right, Chris, owner occupied again,
Yes.
but with the spin of now it's a duplex. So I live in one side and I rent out the other side, or it's got like a mother-in-law suite. And so you're renting out the basement or something like that, or even just buy the room and you have roommates. And so you're living in an owner occupied house, but you have roommates that are helping offset your costs.
You nailed it. And what I want to do here is actually, we're going to compare the house hacking versus the BRRRR strategy. And Justin, I mean, you're an investor in the real estate industry right now in the current market cycle. Is it easier to find the BRRRR property or easier to go out there and find a single family home nomad / house hack property?
Oh, definitely easier to find like an owner occupied nomad or house hack.
Yep. And so this kind of brings me up to this next slide. And this is what I started describing to a lot of my clients is, hey, the BRRRR and flipping as well, they are phenomenal strategies. But I really relate those to more being like a business or a business or a job. You're out there, you're having to network with multiple agents and wholesalers, do some of your own marketing, find deals. You're having to coordinate hard money and general contractors. There's just a lot more moving parts. And I can
Yeah.
relate it more towards, and then, for house hacking and nomading and the type of condos and rentals that you and I buy, Justin, it's a lot more investing. Doesn't take a ton of time. You're not having to spend lots of time going out there. And so I relate it to a lot of people have like 401ks for their work. Hey, taking 5% of your check every 2 weeks to your 401k, it's investing. That's like buying a rental or house hacking versus going out there and being an active day-to-day day trader is more long times like flipping and BRRRRing. They're both great. They're just two different things.
Yeah, 100% agree. The BRRRR strategy is basically a fix and flip, right? You're finding a distressed property that needs repairs. But at the end of the day, after those repairs, you're not selling the property like you would with a fix and flip. You're going to refinance, right? As one of the R's in the BRRRR strategy says, you're going to refinance it and keep it as a rental property. And so now you're out there trying to find vacant properties, distressed sellers, right? And like you're alluding to, there's a much smaller pool of those sellers and those properties. So and a lot more time intensive as well because of all the repairs.
And I'm not saying one's better than the other. I'm just pointing out the pros and cons on both. I mean, I wish I could find lots of BRRRR properties right now. They're just really hard to find right now.
Absolutely.
And so you have to think about, as we were talking about, your time, your skill level, the risk level, your network, the amount of capital you have, deal flow quality, to name a few. And so comparing those two, I want to run through an example of the BRRRR, and we'll do this on the quicker side because this could turn into a whole 30-minute conversation for here. But I want to show you some examples of some numbers on here. So here's an example that I think this was a Joe lender and I think a Pine Financial deal that you guys did with an investor, if I recall the strategy correctly. Purchase price at $225, about $30,000 in rehab cost, and about $12,000 in closing cost. And the down payment needed on here was $1,000 because they got a really good hard money loan through Pine Financial, and they got were able to bring minimal cash to the table because they were highly leveraged, with Pine. So that's the buy side. They rehab it, and then after 2 months, they call Joe or another lender and get it refinanced. Joe's new loan is for $266, which pays off a lot of the previous stuff. New closing cost, and your new loan is about $271. And you can bring actually $0 to the table. So this is what everyone wants to do. And so for about $12,000 total for some down payment money and then your carrying cost, while you're paying the hard money payments, your interest, insurance, all that stuff, you're all in for about $12,000. Property rents for like $2,700 and your cash flowing like $9,000 a year. That's 75% cash on cash return. Who doesn't want this? I do.
Yeah, all day long.
Yeah. But you can see we don't have it on this slide, but mean, same thing. Hey, $27 a month in rent. That means you'll have about $1,800 in NOI after it's paid off. So whether I BRRRR this or house hack it, that monthly rent's the same. And when it's paid off, it's the same amount of money. The difference is the cash to bring down and the all this other moving parts on here. So I'm gonna go through this again real quick with one example. Let's say you go out there and okay, the price goes from $225 to $245, and your rehab goes from $30,000 to $40,000. Just I'm sure in your draw processes, people never ever go over their budget, right?
From time to time, that happens. Yeah.
I say that because any project I do, whether it's like a $50 project home or a rental project, I always go over budget. So I'm poking fun at myself too. Everything else is the same here, but just those higher rehab costs and higher purchase price. But now, when you do all of it, you're all in for about $37,000 for the same rental property. Your cash flow is about is still $9,000 a year, but now you have a 24.5% cash on cash return because you have more cash in the deal. So I know we went through that quick. Do you have any questions out there, Justin? Does that make sense?
Yeah, no, so that all makes sense. But of course, I've seen these slides before. So, if anybody's watching, especially on YouTube, on our on Pine Financial's YouTube channel, pause this and take a look. Reach out to Chris or myself if you have questions. I don't understand this. How'd you come up with that? Reach out to us. We'd love to explain all this to you. And we have other classes as well where we go through these scenarios and formulas, and we take a little bit more time. So for, the sake of the webinar and the time that we have allotted for this, we're kind of rushing through it, but, reach out if you have questions, let us know. And we want to make sure everybody understands all this math because, the real investing is not the fix this, flop that, I bought it for here, I did something and look, I'm a millionaire, right? Like there's actually a lot of moving parts and numbers in this stuff. And it's really important to understand all those numbers. So please reach out to Chris or myself. We'd love to chat with you and help you work through all these numbers.
I would definitely almost second plug in the other webinars and classes you guys do, because I know you guys talk a lot about this. And it's those two slides is an easy 30 minutes.
At least, yeah.
So the difficulty of BRRRR here, I mean, this is a little subjective, but I put most of these things at high or medium just because there's a lot of skills and moving parts and time involved. Or if you go Nomad, Justin, do you know the #1 source where we find our House Hacking and Nomad properties?
I'm going to say on the MLS with real estate agents.
Correct. I mean, that's where we find the majority of them. And that's not just me. That's every agent I know that does this. The vast majority, I want to say like 99%, are on the MLS because that's the greatest inventory out there. And the other thing too is it's hard to go house hack if you want to go find one of these off-market deals from a wholesaler that require a 5-day close. A little hard to use your FHA loan for a quick close, or a lot of times they don't like wholesaler contracts. Like it sounds good, but doesn't work in practicality a lot of times. And it's really hard too to go out there and use a hard money for an owner occupant and then refinance an owner occupant, right, Justin?
Yeah, there's definitely rules around that. Different types of loans, and so for us at Pine Financial, no, we don't do anything owner occupied. So we couldn't even come in and help. And most of our competition, most other hard money lenders are in the same bucket.
Yeah, and that's what I found too. Is obviously like we do a lot of work together, but other people we don't do it either because there's a lot of rules around it. So all right, so kind of getting past that, I want to give you that comparison because I'm not saying don't pursue the BRRRR, don't pursue the flip. The last thing I'll say on this is that I've had a lot of clients, or I should say not clients, but people I talked to 3 years ago. Nope, I'm gonna BRRRR, I'm gonna flip, and 3 years later, they still bought 0 properties. I've had other clients who are like, hey, I'm gonna go out there and house hack, and now they have 2 or 3 properties. It's a lot less sexy of a Facebook post, but in 30 years, that's what builds you the wealth. So if you want to still pursue the BRRRR and the flipping, by all means do it, but maybe house hack along the way so you're kind of getting the best of both worlds. Especially if you're out there renting and you want to BRRRR and flip, by all means do it, but buy a damn house hack, please. That's one of my pet peeves. So this is just kind of the next data and all the talking points I go off is just going to go off of weekly conversations I've had for the last number of years. a lot of these numbers and stuff I'm going to share, it's going off numerous conversations. I do this, 40, 50, 60 hours a week. And so keep in mind that one of the biggest things with doing a house hack is you're really balancing your personal needs with your investing needs. Like, Justin, your condo looks great on the spreadsheet. Would you want to go house hack that condo?
Honestly, right now, no. I mean, I'm married. Yeah. I've got 2 kids. And no, so living in a smaller condo compared to where we are now, that's not ideal.
And so this is where now, if you were, rewind when you were, let's say you had all this knowledge when you were fresh out of college and you're 22, would you have house hacked it?
Absolutely.
Yeah.
Absolutely.
And I'm in the same boat. I've got a family as well. And I wish I had a time machine. So it kind of depends where you are in life. And you can do it, whether like you have a family like just me, or you're single or you're married, but it's that balancing act there. So one deal that may work for you won't work for me and Justin. So, and a lot of times too, since we're balancing there, a lot of people tend to kind of buy nicer properties in nicer areas. So a lot of times in Denver, that's on the west side of town near the mountains, still a really good price to rent ratio, but you're close to the mountains, which is a big reason people move to Denver, not to be close to the airport. So the most common house we sell is right around like a 4-bedroom, 2-bathroom detached house on the west side of town. That's like now it's about 400,000 to 500,000 range. And the west side, that's like west of I-25 for people that are familiar with Denver. So here is a screenshot of, this was not today, but this is recent, of how many 400,000 detached 4-bedroom plus or 2-bedroom, 2-bathroom houses there are. 276 active deals. Now, will all they all look for house hacking? No, but I don't see 276 potential BRRRR properties a day or flips a day. I wish I did, but it's just lower inventory. MLS is a big pond, a great place to go fish. So can you go out there and find a quote unquote a deal? Yes, you can. So multifamily. We get this question all the time in Denver, Justin. I think a lot of other markets do as well, because a lot of, like, the bigger pockets and these websites, they talk about, the great house hacks, which are, multifamilies or fourplexes. And right now in Denver, we just have very low inventory. So for example, like duplexes are below like 600,000. We've got 18, and I actually should read like 700,000. There's about 18 of those. Triplexes are about 750. We have 5 of those. And fourplexes are about 1.1 million. There's about 11. So that's about 35, 40 properties, which is pretty typical. And I use those price points because that's right around the amount you would need to still fit within the loan limits of an FHA loan. So for a low down payment, you can only use an FHA or VA loan. So you can only have, generally speaking, one of those loans out each at a time. So usually it's a lot of times like the first house hack people do a multifamily on. Now with FHA, you have a higher health and safety appraisal standard. Justin, you own a duplex, you know the rental scene. I think you've probably gotten a black eye putting offers, in the past, like, it's rough out there. If you were selling a multifamily and I bring an offer with an owner occupied FHA, someone else brings you an offer with a investor with a conventional loan, and they're the same terms, who are you probably going to pick?
Probably go with the conventional.
Why?
It's just a little bit easier all around, right? They're not going to hate on my property as much.
Exactly. Like, they don't have the FHA appraisal standard, and the investor, they care a lot less how the property works versus someone that's living there for a year. So the other thing that makes this difficult is that you must be able to move in within 60 days of closing. That is a requirement within the loan. So even if Justin's duplex, let's say they're both leased up until like next year, 10 months out, even if I wanted to move in there, the lender would say, oh, there's 2 leases on this property. No, you can't move in. We can't give you the loan. So out of those 35, 40 multis on the market right now, I don't know what percent, but definitely a good chunk of those have leases in place where I or another owner occupant could not move in there. So, and roughly, like I said, about 1 out of the last 16 transactions we've done has been a multi. Not because we haven't tried, not because we haven't looked, just because for these reasons, and because rather than 40 properties available, there's 200 plus properties available in single family homes. Does that kind of make sense, Justin?
100%.
For the listeners, do you think? Cool. So in big red letters, my advice is don't get tunnel vision on a multi. It's not a make or break deal in the big picture. And I'll go through towards the end an example that I did personally, my very first property I ever bought, which I said I got for so cheap. This was at the bottom of the market 10 years ago. I said, I am never selling this thing. It's so cheap. I'm just going to pay it off. And then I learned some more advanced investing strategies. And guess what? I sold that. And I went out there and bought a better rental property. So let's go through a quick example on financing just to really drive home on here. So if Justin's house hacking a $400,000 home and I'm buying the home as a landlord rental, I'm most likely going to have to put 20% down, which is about $80,000. The interest rate I have on here is at 4.875. It's a little bit outdated right now. This was pre-COVID with these interest rates. We're going to update them. Right now, it'd be like 3.5%, let's say. Plus about $5,000 in closing costs. So I'll have $85,000 in cash. If Justin is an owner occupant at 5%, his down payment's $20,000. And on the slide, I have an interest rate 3.875. Right now, we're closing house hacks at 2.5 to like 2.75% interest rate. So a lot lower.
Yeah,
Plus,
so that's because, right, interest rates are different between an investor or an owner occupant, right?
Exactly. Because, if we both own these properties and we both lose our jobs, who's more likely to stop paying the mortgage payment? I, the investor, is, because I don't live there and I got to make sure I pay my house so my family's going homeless. But Justin lives there. He's going to prioritize paying that.
Yep, exactly, right? So it comes down to kind of like the risk and reward for the lender, right? More risk in lending to an investor, so they charge more.
And I have the payments up here. I have $1,693 for the investment loan. That's the higher interest rate, and $1,834 for the owner-occupant loan. So obviously they'd both be lower, but a lot of times it's within like a $200 difference like this. It's not a huge swing on there. So personally, is it easier to save 20 grand or 80 grand? Well, I can save 20 grand faster than save 80 grand. And I know Justin and else is the same way. So, realize a big reason people buy house hacks is because they are an amazing way to buy future rental properties for very low down payment. And you get the best interest rates in the world. To kind of highlight, some hard money stuff in that world, what's the hard money interest rates, Justin?
10, 12, 15, 18% interest.
And that's the going rate because that's a higher risk loan for a shorter term period. But now since you're buying these owner-occupied properties, you get the best financing in the world, which are these government-backed loans through Fannie and Freddie Mac. Like, they are amazing interest rates. I mean, there's no way, an average person can compete at that low interest rate. So here's an example. And this is when I run a lot of times my clients through here in Denver. So Justin, pick apart this and whatever speed you want to put on there for other markets you guys are in as well. Let's dive into that. So I'm assuming someone's $30,000 in starting capital and they can save $2,000 a month. And that's them saving from their personal savings because they're being frugal. And also from any income they're having from once they buy their first house hack from, having some other roommates paying down, paying their living expenses. So to keep it simple, we're not finding the amazing multifamily here in Denver. We're finding one of those 4-bedroom, 2-bathroom places here in Denver. So the kind of sweet spot right now in Denver is go buy the house, live in one room, and rent out the other 3 rooms. $700 a month is extremely conservative. We're usually between $700 and $900. So I'm on the lower side here. So if you own a house, but you're bringing in $2,100 a month in rent while you're living there, that's taking care of most of your mortgage. And a lot of times people are living for a couple $100 a month while they're building equity. Plus insurance, taxes, putting money aside for vacancy and repairs. I mean, it's all the good stuff we should do as investors. I'm not going to talk about PMI because that's a really advanced topic. That's just a lever to pull, and we can give you a resource at the end to really understand what PMI is. So what we're going to do here is we're going to take the same scenario and buy the next property after 2 rules, after 1 year and after we have enough cash for a down payment. Because the 1 year, is what Justin said earlier. You have to live in that property for 1 year. Otherwise, the lender won't give you a loan for the next property under most circumstances. And you also need enough cash for the next down payment. And then we're going to repeat this 5 times, and that'll get us close to that goal we talked about earlier. So I'm going to go through a real-life example of a house hack that we closed on, I think, 1.5 years ago, but it's just a really good case study. It's in Arvada, which is a nice suburb, but not downtown, not the hot part of town, just standard suburban home. It's probably the best way to describe it, right, Justin?
Yeah, absolutely. It's a nice part of town, but certainly not, the fancy part of town.
Yeah. And so this one was actually 5-bedroom, 3-bathroom. This one we actually bought from a flipper, and they actually did there's 2 types of flips. There's a good flips and there's a bad flips. This was a good flip. And so a lot of times we're buying flips right now because a remodeled property is often not that much more expensive than a property with 1970s green avocado appliances and countertops. So buy a little bit more, and then that way it should be easy, and we should have very low maintenance for a couple of years, and hopefully mechanicals are updated. $430 purchase price. We actually got $10K below list, and we got some inspection concessions. And this was a client's second Nomad property using a 5% down loan. So we're just going to assume this is property number 1. And Justin, the market is finding a single-family home in Arvada for around $450,000 and impossible feat.
Nope, not impossible. No.
No. I mean, it's more competitive right now. You're probably going to lose out on an offer or 2, but it's very doable.
Yeah, that's a fair price.
So I'm plugging in all these numbers in a spreadsheet. And I've actually got the higher interest rate plugged in here because this was a pre-COVID property. I did not update it, but I understand you actually have greater cash flow now because your interest rate's about 1.5% lower now. And that does a huge savings to your property. So I plugged in some normal assumptions on here, and we can link to the slides if people want to actually go through the numbers on there. I know for time's sake, I don't want to go into too much of the weeds.
Perfect.
But here's a really cool visual guide on here. So you can see the cash flow here in the upper right, this upper right green box. Once you move out, you're making $466 a month. Or I'm sorry, $466 a year in cash flow. Justin, if you hear that in cash flow, what's your reaction?
Per month, I'm interested. Per year, I am very turned off.
Right, exactly. But the other thing in here, this is interesting with house hacking. His total initial investment was about $24,000. So it gives you a 2% cash on cash return, which is not nearly as sexy as that BRRRR property we talked about a few minutes ago. But if you look at how the other ways to make money in real estate, which is appreciation, and Denver is a market that we have appreciation. Some markets have it, some don't. I know you don't bank on it, but Justin, do you expect your properties to appreciate here in the market?
Yeah. So, I think similar to you, Chris, I have a very long-term, horizon for my investments. And so, yeah, the market goes up, it goes down. Everybody's holding their breath to see, well, I guess for a couple of reasons, because of coronavirus right now. But even still, right now, where we're the second half of 2020, the market has continued to appreciate. So, but over the long term, 10, 20, 30, 50 years, Denver has appreciated. So yes, to a certain extent, I do bank on appreciation because I have such a long-term horizon for my properties.
Yep. And that's exactly the right point of view for house hacking. You're not getting rich on day one, but you're buying a great asset. And guess what? If I bought that BRRRR property and Justin bought this house hack, when the properties are paid off, they're giving us the same cash flow. But I bought that property for $23,000 down, which was more than one example, but less than the second example. So you're buying a great asset for really minimal money in our pocket. If you look at the 4 ways of money in real estate: cash flow appreciation, principal reduction as your tenants are paying down your debt, and the tax benefits of depreciation, you're making about $32,000 the year you move out, which is an overall return, which is pretty phenomenal, which actually gives you 130% total return, which is a little bonkers. And that's just because, and yes, the math is correct, that's just because you're so highly leveraged, because you put $24,000 down. You're just highly, highly leveraged. So now let's say after 1 year, you move out, convert the previous home to a rental. Now the new purchase price is $456,000. Appreciation cuts both ways. It's great when you own the property and you go buy the next property. Damn it, it's more expensive. But here's the thing. Even when the prices have appreciated, you're only bringing about $27,000 as a down payment. So that's like about $3,000 more than the previous example. So the property's gone up $20,000 by having to bring an extra couple $1,000 in the down payment. $27,000 is still a doable amount for someone to save and buy another property with. So you got one rental property, and assuming you've increased your rents like a good landlord, you're cash flowing about $2,500 a year. Property 3, now the property is close to $480,000 in appreciation, or I'm sorry, purchase price due to appreciation. Now your total cash investment when you buy number 3 is just under $30,000. So a couple $1,000 more than the previous. But is it impossible, Justin, for someone that, they're a saver, they're frugal, they got roommates? Is it impossible for someone to save $25,000, $30,000 a year? I don't think it is.
Oh, it's not easy. It's not easy, but
now with 2 rental properties, when you're in your third property, you're making $6,000 a year in cash flow. All right, we're kind of getting somewhere decent now. Now you're on property number 4. And again, we're assuming you're buying kind of the same rental property, same neighborhood, kind of same stats, just for, we're modeling here. So we have to kind of keep something simple.
Yeah, now so you buy the same house, still in Arvada, like you're just moving next door down the street type of a thing.
Yep, exactly. Now the purchase price is north of $500,000. Again, appreciation. Total cash investment is like $31,000. Now you have 3 rentals. Your cash flow like $10,000 a year. You're about living for free. Hey, 27-year-old Justin's not doing too bad here, huh?
Just 27-year-old Justin wishes he knew this information.
27-year-old Chris does too. So now we'll go to property purchase number 5. And now again, it's appreciated. Now it's about a $25,000 higher purchase price. Your total national investment's about $33,000. Still a good chunk of money, but it's not unattainable for someone to save, or maybe rather than 1 year, it takes you 2 years to save. It's attainable as you save money and you reduce your living expenses. I mean, my mortgage payment is one of my biggest expenses. Probably yours too, right, Justin?
Yep, absolutely.
So at this point, you got your 5th property. Now you're making about $15,000 a year in cash flow. So honestly, what happens is, 28-year-old Justin and 28-year-old Chris probably might get a little nomad fatigue. Might be getting married, might be having kids, maybe getting a little tired of moving every year. So we call it nomad fatigue. And a lot of times we see people getting from like 2 to 5 properties. It's pretty typical. So even if you get a couple properties, your future self will thank you. And I'll show you. I bought one house hack property, and I'm very grateful I did. I'll show you those numbers towards the end. So you keep nomading, go as long as you want. Very few people can do that. Or a lot of times people start moving towards traditional investing. Hey, they got 4 or 5 rental properties. Like Justin, if someone comes to you, 28-year-old Justin comes to you now, and they're like, hey, I got 5 rental properties. I have a primary residence. I've got cash reserves. I got cash flow. I've got 3 years of self-management experience where I hired a property manager. They're a pretty damn attractive loan applicant, right?
Yeah, absolutely. 100%.
Versus someone with no experience and no assets. And obviously you got 5 properties, you get your finances together. So a lot of times they'll start moving towards traditional investing, and they'll have the option, as I call it, get a little savvier and start repositioning equity, which is a really fancy way of saying, hey, as you're paying down your principal and the properties are appreciating in value, what's building? It's your equity. And that's like your real estate piggy bank. It doesn't get deposited in your account every month, but you can tap into it. And I mean, most ways to tap into this is you can do a cash out refi, you can do a HELOC, or you can sell the property. I've done a cash out refi and I've sold the property tapping in equity. Justin, you've probably done, I know you've done a couple of these.
Yep. So just recently did cash out refinances. And for us, we had paid down so much principal and the equity had increased so much that we had HELOCs on these properties. And in the cash out refinance, we were able to pay off the HELOCs, lock that into the long term and the lower interest rate. And so we've done all that, right? We had HELOCs and then we did the cash out refinance and rolled it all in together and was able to pull cash out. So yeah, absolutely. This is kind of one of my favorite things to talk about when we're talking about, long-term rentals.
Yep. And like I said, this is when I said I bought that first property 10 or 11 years ago, I didn't understand this concept of repositioning equity. And then once I learned, I was like, oh yeah, I need to do that because that's the greatest return on my money. So, you're not getting rich on the cash flow, but even just hold on those properties when when Justin, when he's 55 or so, they're paid off. And that's an early retirement right there of, like $10,000, $12,000 a month in income. That's a lot of money. So here's actually my example. So in 2011, I purchased a 3-bedroom, 2-bathroom condo for $67,000. Bottom of the market. And it was just dumb luck. Bought it and then lived there for a year, like 2 years. And then in 2014, I moved and I converted to a rental. Never made a lot of cash flow. I cash flowed like $100, $200 a month. Like, my account built up, but I actually never, ever took money out of that checking account because I think the highest guy was like $15,000. So never actually used the cash flow other than, paying off the property, doing things like that. Now, 2019, I sold it for $229,000. So that's a lot more than $67,000. So that's the huge equity build. And when I bought the property, it was rents for like $1,000 a month. Now rents are like $1,300 a month in the future. So my rents went up like 30%, where the price like tripled, went up like 300%. So the market gave me the greatest return in appreciation and therefore equity. So I should probably tap on equity because it's not a great rental anymore. So, I basically sold it. And after all the transaction costs, and this was actually, I know this was in Nevada I bought, and so I paid full commissions and all the normal costs for selling the property. Didn't sell myself, didn't get a deal, sold it like anyone else could out there. I walked with $172,000. It's a lot of money. So I did a 1031 exchange, which is a way that allows you to defer capital gains on these. And I used it to purchase a fourplex for $850,000 here in Denver. And this fourplex, it was a good deal, but it was not the deal of the year. It's not a smoking deal. It's just a slightly above average deal. So my monthly rents in the fourplex are about $6,600 a month. Justin, your math whiz.
Let me get my calculator. Hold on. Okay, I'm ready.
Is 6,600 or 1,300? Which one's bigger?
6,600.
Yes. So when I have both these properties paid off, which one do you think puts more cash in my bank account?
The fourplex.
Exactly. So here are all the numbers on the property, and this will be in the show notes. You guys want to actually digest all the exact annual operating data. But basically, I'm gonna give a comparison here. My condo return, my cash flow. Once I owned the condo at that time, was making about $3,000 a year. Now, if I use the 33% rule, once it's paid off, it would cash flow about $10,500 a year. Not bad, but if my goal is to get to $10,000 a month, I need 12 condos. Now, the fourplex, it cash flows about $12,000 a year right now. It's about $1,000 a month after expenses and the mortgage. Now, 33% rule, once it's paid off, is about $53,000. We'll just say $50,000 to round down for easy math. Again, Justin, using your calculator, does $10,000 a year or $50,000 a year get me closer to my goal?
$50,000 is bigger.
Your math skills what makes you a great lender. I got to tell you, Justin. So exactly. And so, Justin, real estate really well. You've been investing for a long time. In this process, was I really lucky? Did I hit the unicorn?
No, I mean, to a certain extent you did in buying the condo, which was the dumb luck of buying at the bottom of the market. But then, I mean, you just did what anybody else would do, right? You just held the property for several years, and then you took those returns and put them into a new property. And so there's nothing crazy about that, especially with the fourplex. There's no unicorn anything there. You just found a fourplex, the numbers made sense, and you went and bought it. And there was no off market subject to, blah, blah, blah. It was just, here's a property on the MLS. I'm going to buy it.
And so now we'll go back to those single family home examples we talked about in Arvada, the Denver suburb. And so now I use some software to talk about the equity at year 8. So right around there, it's like just over $1 million in equity. Again, we're assuming the straight line appreciation assumptions. We're assuming the debt down payment. Will the market keep appreciating the next 8 years? I think it will, at least in Denver during COVID. But let's say it goes a lot less. Okay, $500,000 in equity in 8 years. Those are both not bad positions to be in when you've put in about $30,000 per property. You're getting some great equity in your property here. So think long term. So that's about it. So I'll kind of wrap up here. I mean, the house hacking and the nomad strategy are powerful ways for building wealth. Remember, it's the accumulating of multiple properties that builds wealth, not buying the most one amazing deal in the world. You did not need Grand Slam property in your first property, and play the long game. We run a bunch of models. I bought another rental like 3 weeks ago. Justin's buying another rental tomorrow. The Denver prices have definitely appreciated a lot more in 2010, but we're still following that same strategy. Buy a place. We're putting 25% down. You might be house hacking putting 5% down. But Justin and I's both plans in 3 years, 5 years, 7 years, we're going to tap in the equity. Now for house hacking, it might be a little bit longer because you put less money down. You might be at year 7, year 9, but that still works in the grand scheme of things. So it's just a very, as I like to say, it's a KISS principle wealth building strategy. Keep it simple, stupid. It's really hard to screw up. The one advice I forgot to mention earlier, it's great you're putting little down, but you're highly leveraged and you're tight cash flow. You have to keep some cash reserves in the bank. So if you do this strategy, please, please, please keep some healthy cash reserves in the bank. What I personally do, and maybe Justin will share what his formula is. What I do, and I tell my clients, is keep 6 months worth of your PITI, your principal, interest, tax, insurance payment, or $10,000 in each account. That's what I do. What's your rough rule of thumb for cash reserves, Justin, if you don't mind sharing?
Yeah. So, I mean, I think Chris, you and I are both in a position, and most of our listeners, I think too, to a certain extent, have jobs. And so we're not trying to quit our jobs, at least not today. Especially some of us, enjoy what we do, but we need something to do with our money, and that's, or to help supplement the retirement or to pay for our kids, college or something like that. And so we're investing in real estate, but we don't need to live on that cash right now. And so I think you had mentioned this, and this is what I do, is I don't touch that cash flow. I've got an account set up, and the rental monies go into there, and it just keeps growing and stacking and stacking. And then when it gets to a certain level, I'll go out and buy another one, or because right now my wife and I are still in acquisition mode, right? So we're still trying to buy a few more properties. But once we get to that tipping point, then we're going to transition over, and instead of building that up and then buying a new one, we're going to build it up and then pay down some of our other ones. But so I want to, but that kind of tipping point for me is at least $30,000, because I have several properties. And so there could be, like you're saying with the PITIs, maybe there's the vacancies, maybe there's the repairs or the maintenance, or one property had a roof. I just got through a turnover where the tenants did not take good care of the place, and we had a horrible property manager. I was the property manager, and I mismanaged it, and so it wound up costing me a $20,000 turnover, plus the missed rents. And so I didn't freak out. I wasn't worried about it because I had planned for this, not, through the mismanagement and that this tenant was going to trash the property and I was going to do it on this day. But I knew something was going to happen across our portfolio someday And so I had the money ready for that. And I think that's kind of what you're saying, Chris, is we don't know what's going to happen. We don't know when, we don't know how much, but we need to be prepared for that. Whatever
Because
that
it
may look like.
will happen.
100%. 100%.
And so just the key here is if you lose a property in month 6, you kind of lose, or it sets you back a lot. If you hold on the property for 10 years, it's really hard not to make a bunch of money in real estate. So that's it for the presentation, Justin. Last thing I'll throw in here is just actually 3 weeks ago, before we are doing this webinar, we published the Ultimate House Hacking Guide for Denver. So I call it a technical guide to building a Denver rental portfolio through house hacking. So it's Denver specific. So if you're in the Front Range, the Springs to Fort Collins, great information on here. It's going to be dialed in for you. If you're out of this market, it's going to have good concepts on there. You'll have to adjust some numbers to your market, but it's technical. It goes beyond a lot of this like very basic first-time home buyer content and books that are out there, which are great. But once you want to know the nuances, like the stuff Justin and I talked about the last hour, it goes into details on there. So if you Google it, it'll pop up on the Amazon page, or if you actually just Google it and find my website, all the chapters on there's a blog post as well, so you can read it for free or go spend $6 on Amazon and buy it.
Yeah, absolutely, guys. This was one of the reasons I wanted Chris to come on right now, is because he was just releasing this, and we haven't talked about house hacking on any of the Pine Financial, the webinar, the weekly videos we're putting out, all these things. We haven't talked about house hacking. And so when I saw that Chris was actually putting out the book, I know he's been helping folks buy house hacking deals for quite a while. It just seemed like the right time to do it. And so that's why I wanted to have Chris on. Chris, really appreciate everything you're saying here. And, ultimately, go back and rewatch this. If house hacking, if Nomad is a new strategy to you, if you haven't heard of this before, go back and rewatch this. Reach out to Chris or myself. Go to Chris's website. It's right there, denverinvestmentrealestate.com. And again, even if you're not in Denver, the concepts, right, are all going to hold true in almost every market. So, and the only way we're going to know that is if you dive in and understand the concepts and then start applying them to your market. But put in the time, study up on this. And as Chris keeps saying, it's such a great way to just get into and start investing with very little money out of pocket. It's not the sexy no money down, hopefully, that you can get through a BRRRR or maybe through a flip. But it's just a solid, proven way to get your foot in the door, start buying properties today or very close to it with less money down, and really start building that portfolio. So Chris, really appreciate you coming on, sharing all this advice and real world deals that you've been through. It's been awesome. Thank you.
You bet. And I'll leave one last thing on here is like, don't get fixated on one strategy. I mean, Jess and I, we're friends. We also, refer back and forth to each other all the time. We are often kind of helping the same client. Justin, through his coaching, his hard money lending, refer people over me for some house hacking stuff. I got people are house hacking when they get into the flipping and BRRRRing. I refer them to Justin. So we're happy to talk to you. We work well together, but also just to keep in mind, like, you have to have multiple people in a real estate team. And this is a big reason we're like, yeah, we're in parallel fields, but we find ways to work together. And actually, most importantly, it helps the client find deals and take, one step closer to hitting their retirement goals.
Yeah, absolutely. Absolutely. So Chris, any other last pieces of advice, or how can they find you and reach out if they want to chat more about this?
Best thing is just go to denverinvestmentrealestate.com or just Google Ultimate House Hacking Guide Denver, and the website will pop up and all the contact details and everything's on there.
Awesome. And Chris, you have an amazing podcast as well. So how can they find that podcast?
Easiest thing is either Google or in your whatever podcast app you're in. It's all, it's in all the main podcast apps. Just search for Denver Real Estate Investing Podcast. As you guys can probably tell, I'm not really creative with names, so it's more very specific. So just Google or search for Denver Real Estate Investing Podcast. We will pop up. We'll be the purple house logo.
Yeah. And again, I've talked to people from across the country who've listened to Chris's obviously very Denver specific podcast, because although the numbers and addresses and, parts of town may be specific to Denver, the overarching themes and strategies and formulas that Chris and all of his guests talk about on that podcast work anywhere in real estate, right? And so that's really probably one of the keys and reasons you've had so much success is you're just, they're just tried and true principles that you're following with your investing and the investing your clients are doing. So, Chris, really happy to have you on the webinar again this month. And as Chris and I have been chatting about, if you need any hard money, if there's anything we can do in that regard, I would love to chat with you about that. You can, of course, find us at pinefinancialgroup.com. Each month we're doing these webinars. You can check out a ton of other content on our YouTube channel. Just search Pine Financial on YouTube. We've got a Facebook page. We're on Instagram. And really what we're trying to do there is just provide massive amounts of content to our clients, to our investors, to our community to help build up everybody's real estate knowledge so everybody can be better investors. So if any of that sounds good or interesting to you, if you need a little hand holding, that's the coaching and stuff that I do, helping people buy their rentals. Love to chat with you about that as well. So of course, check us out at pinefinancialgroup.com and on all the socials. But otherwise, everybody, thank you so much for joining us, and we'll see you again next month.
Thanks, Justin. Bye, everyone.